All right, you trader nerds, how are y'all? Hope everybody's doing well. Boy, I had the best lunch today. I had Fiesta lime chicken from my favorite place, Applebee's. God, is that good? And instead of their rice tastes horrible. But if you'll get mashed potatoes with it and then ask for a little cup of stir fry sauce, friend, let me tell you something. Take that little piece of lime and squeeze it on that chicken. Bam, baby, is it good? So welcome in, y'all. Hope you're having a wonderful, wonderful day. Hope everybody's doing good. And we're just going to take it a little slow today. I kind of want to share with you, let me share with you what we're going to do in our Muscadine Mafia session today. If you're not a member of the Muscadine Mafia, you need to be there because it is cool. And let me show you what we're going to do. Got an email. And gentleman is, where did I go with it? Oh, no, did I miss that? A gentleman is doing a little back test. And he's coming out with some really cool stuff and figuring out different questions and different things and different things about, hey, should we actually be spending $200 on the, and well, a lot of us have asked this before, right? Should we ever, is this really what we should do? So what we're going to talk about in the Muscadine Mafia session immediately following is this. So anyway, Cameron sends me an email, says, so right now the 112 strategy employs a trade level hedge. In other words, it requires us to spend $50 out of the $200 collected, which gives us a protection of $50 to $200, depending on the date, DTE or the put debit spread. What if we move the hedging from a trade level to a portfolio level? So then he brings out that a 60 DTE on demand hedge using ES will cost you about $500 and provide a protection of $10,000. So what he's saying is, hey, you're getting a lot more protection, right? With $10,000 protection. One can finance this hedge with just 10 trades and still have $8,000 of extra protection. How about selling another 10 naked puts? That's where his estimates of 15 to 20% return are coming from. He'd love to get my insight on another thought. The worst sell-off of the market ever was about 20%. And that's kind of what we look at when we're looking at our stuff, right? Naked puts are roughly 15% away from the spot price. I argue that position will be 5 to 10% in a loss at the expiration. So if the naked put strike is $4,000, the loss will be $200 to $400. I argue that a better strategy would be to take the assignment, start a wheel, because statistically that will be the market bottom. From the buying power reduction perspective, it'll be roughly the same. In other words, about $1,500 per naked put. That's all interesting stuff. So in Muscadine Mafia today, this is what we're going to just play out, right? We're going to do an analyze tab. And I think y'all like it when we go deep diving. And that's kind of things that we do during Muscadine Mafia sessions. So really, really good. So y'all, what are some popular option strategies out there? Let's talk about them. Popular option trading strategies. Well, if you're a Wall Street bets guy, those people buy options, right? That's generally what they do. They buy options because it's a lottery ticket. Y'all, I used to play the Georgia lottery with about 20 marshals, federal marshals, U.S. marshals from Birmingham. And I lived in Georgia, so I would always get the tickets. And we would buy 200 or 300 at a time. And I think the most we ever won was $80. It's nice if you hit, but the probability is so low, y'all. Oh my gosh, low probability, right? I mean, you are going to strike out, and you may get a big hit every now and then, but buying options is for losers. So that brings us to the most popular option strategies, I think. Well, it may not be the most popular, but it's what we do, because we become the casino, we become the bank, we become the insurance company, and what we do is we sell options to these losers at Wall Street bets. We sell them because they're dumb. They don't understand probability theory, and you and I do. We understand that we have maybe a 52% edge when it comes to the roulette wheel, But that 52% versus 48% is amazing. And it will allow us to build amazing kinds of structures and all kinds of, uh, big buildings with brass and gold and all kinds of stuff. So we love to sell options because we have a high probability of success. And we love that. I was telling my son yesterday, I said, son, why don't you come work with me in the options field? And let's do some things, let's create some things, and let's rule the world. And he said, Dad, what's your probability of profit? I said, 90%. He said, nope, I don't want to do it. He said, because that 10% can be rough. Is he not correct, y'all? Losing 10% can be rough. And that's why we spend 80% of our time talking about how to manage chaos. But we sell options because we have a high probability of success. And the most, I guess, basic of all selling options is selling a put. So you sell a put out of the money, right? Out of the money puts, and you sell those maybe where you have a 70% probability of success, or you have a 60% probability of success, or you have a 50% probability of success. And doesn't matter. And you collect premium. Now, here's where everybody gets greedy, though, right? So they'll say, well, wait a minute. If I sell a put, I might as well sell a call above the market because there's no additional buying power, right? If this took $1,000 buying power here, the broker, the risk management team will not charge you additional buying power reduction or collateral because they know you cannot lose both on the put side and the call side. So they don't do that. So selling a put, selling a call is where we do the most basic thing. Now, if you guys follow on Reddit the guys who are at Theta Gang, y'all, I went in there and I was talking all kind of strategies about selling Theta and everything. And someone quickly let me know that Theta Gang really is nothing more than a gang about the wheel. Everybody knows what the wheel is? The wheel is where you sell a put, and if the price of the stock stays above the put, right? I guess it should look the other way. If the price of the stock is above the put, you keep the premium. Kind of like an insurance company. If there is no fire, you get to keep the premium. You don't have to do a payout. If the price of the stock is less than the put at expiration, you are assigned shares. Or if you're like us and you trade futures, you are you're assigned an exercise. You get assigned an exercise with actual futures, right? So you go, crap, my one put that I sold expired in the money. So let's say that the stock was 100 and you sold the 90 put, and put goes down to here. You now own 100 shares of XYZ at $90. But you got to keep the premium. You just own it at $90. So now what do you do? Well, now what you do is you sell calls against it. So you own 100 shares, which gives you a delta of 100. And now you're going to cut your risk because you're going to sell a call, right? And by selling a call, that's going to reduce your deltas by 50. So in other words, you see what I'm saying? You reduce your deltas in half and you sell a call above the price of the stock. So now when you did the 90 below, now you sell a call maybe at 110. And let's say you get $100 worth of premium there for that. You get to keep that as long as the price of the stock does not go to 110 or more at expiration. What happens if the price of the stock goes above 110? Then you're going to be called, your shares will be called. That's why they call them a call. And somebody will exercise your call and they will suck your 100 shares away from you. And you go, crap, the stock went up to $124. I could have made up to $124. Yes, you have limited your profitability. And by limiting your profitability, you have increased your probability of success. So what the most popular strategy is selling a put. Probably the second most strategy is selling a strangle. Oh my God, Bobby, what's a strangle? Well, how come that won't move? A strangle is the simultaneous, and God knows I can't spell that, simultaneous sale of a put below the price of the stop, so maybe at 90, and a call, maybe at 110. So that you have basically strangled on either side the price of the stock, and you collect premium. Now, some people don't like this because you have losses to infinity to the upside. If the price of the stock goes up to 1,000,000, which we know it won't do that, but let's say it goes up to 1,000,000, then you are in bankruptcy and you are insolvent because you have lost everything. Because what you sold for $1, you might have to buy back at $10,000, for instance. So people don't like that. And what if the stock goes out of business and goes to zero? Oh my gosh. Then you've got huge losses to the downside. So what people who are a little more conservative do is they say, I'm going to define my risk. And what they do is they sold, so we'll say negative put here, negative call here, and then they'll go down below this put and they'll buy a put. And then they'll go above this call and they'll buy a call. And so what has happened now is they have a defined profit, whatever the money that you sold the options for, or this combination for, is a defined profit. So you may have sold this for $100. And you may have a defined risk rather than to infinity and above. You may have a risk of, say, $300. Now, that's the max that you could lose. Now, a lot of people go, wow, that's what I want to do because I don't have the unlimited losses. The problem is it lowers your probability of success. Okay. And this type of trade where you sell a put and you buy a put and you sell a call and you buy a call is called an iron condor, which is a very popular strategy. And ladies and gentlemen, I can remember when I first started watching Tasty Trade, I can remember we were at a band reunion at high school and we were all there and I was like, y'all, I have found me something. They said, what? I said, I have found an iron condor. Iron what? I was talking to my friends about, you know how people's eyes glass over when you're talking to them about this stuff? I said, man, I have found the stuff. I get a 67% probability of making $100 and a 33% probability of losing 300. I said, I'm going to make me a fortune. And they thought I was a fool. And I guess what? I was a fool because all I did was iron condors and I lost money. Because iron condors over the long term, now some of y'all are going to disagree with me. Well, Bobby, not if you'll do them 100 points wide or not if you'll do them blah, 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 blah. I got it. But I'm telling you, over the long term, iron condors suck. Now, I know some of you do them on zero DTE and you're doing them different, blah, blah, blah. That's fine. But I'm telling you, a 45-day iron condor, and you're going to do that on all these stocks with high volatility, you are going to suck and lose money. But Bobby, that's what Tasty Trade told me to do. Friend, I'm just telling you, you're going to lose money because I lost money doing that strategy. Now, if you do just one side, let's say you just sell the put and then buy a put farther away out of the money, that's what you call a put credit spread. You can call it a vertical or a put credit spread, and that's half of an iron condor. Or you can do it on the call side. You could sell a call spread, which is a bearish play. Iron condor is neutral. And if you sell a put or you sell a put credit spread, that is a bullish strategy. Now, y'all, here's where we get all kinds of fancy. You are hearing about, okay, Sarov says zero DTE iron condor sucks even more because of gamma ray. I'm telling you, y'all, I used to do them. I used to do that zero DTE stuff, and I sit here all day and think, God, I got to pee. Boy, I wish I could go tinkle in the potty, and I couldn't because I was afraid that price was going to move against me. Someone said, Bobby, that's why you have, what is it, a screen in your bathroom as well, or a table tray where you can keep your laptop on it when you go to the bathroom. That's why options traders don't stand up when they pee. Option traders sit down because they're looking at their phone and looking at the market. Now, my apologies to the ladies out there, but y'all get what I'm saying. So we can do all kinds of things to where we change up the nature. Like you may sell two or buy one or sell two puts and buy or sell one call, and they're all just buying and selling puts and calls. So when you're thinking about what are the most popular option strategies out there, there's a lot of them. A lot of people buy options. I would say fewer people probably sell options. Those are the smart ones that sell options because we could lose money, but our probability of profit is so much greater. I mean, let's just look for a minute. I'm an overall seller of options, right? So I overall sell. Oh, that's one of that thing's there. I overall am a seller of options, y'all. And look at what we are able to build here. We're able to build something that looks like, where's my thing here? Yeah. Ta-da! Here's where the current price of the stock is that we're in. And we make $19,000 regardless of how far up the stock goes. Isn't that great? What happens if the stock goes down? We could make upwards of $64,000. But we take risk. It's like someone in Facebook said yesterday. They said, all the Vega risk is going to kill you, dude. You don't even know, man. You're dumb as a rock. And I'm like, I've lived through some things, y'all. I've seen some things. I'm not saying I'm not going to blow up an account. I'm not. But y'all, the chances of a casino or an insurance company going out of business when you have the requisite risk management is very low. Very low. In fact, our probability of success, again, this is what we're going for, right? Our probability of success looks something like this. I know. I got to switch. Look at this. Probability of profit, 99.5%. I will take those odds any day. It's saying that, hey, based on the current portfolio that I've constructed here, which is better to the bearish side than it is to the bullish side, even though I kind of like the bullish side better, you got a 99.5% probability of profit, dude. Now, what if you buy an option, right? Let's sit there and let's say, I don't know, man, we never trade anything that's not S&P 500 related. So let's just go in and let's say, I don't know, NVIDIA. Yay! So here we are on NVIDIA, right? And NVIDIA is like, we know it's just been going nutso. Look at this. It was just $400 a couple of days ago. Now we're in the 400s. And you sit there and go, man, that's going to continue. So you go your trade tab and you go, man, I'm going to do some 40-something days out, 35 days out. And I think that this thing is going to go up. You know, let's say the expected move says it might go to 590. Shoot, you know it's going here. So we go out and we buy the 570 option, right? We buy the 575 call. There's only one problem with that. And the problem with buying that 575 call is you only got a 26% probability of success. You have negative theta, which means every day you're losing $31 as that option decays, right? So your max profit, though, here's why people get all excited. It's a lottery. If the price goes to 10,000, could you imagine? You'll be a multi-gazillionaire. But more importantly, you're going to probably lose the amount that you spend on the option. Your max loss is probably your probable loss. And what does this look like? What does the NVIDIA thing look like here? So let's go to curve and let's go to analysis. And so here's what she looks like, y'all. Everybody see this? Here's the risk profile. If price stays here at 540, whatever that is, 548, then you're going to lose your 1320. Even if it goes up from 548 all the way to 565, you're going to lose your 1320. It's only when you start getting up here to the break-even point, right, up to around 588 before you start making money. You got to go up, what, 548 to 588? That's 40 points. Probably would do it, right? And if it goes more, look at this, y'all. If this thing happened to, in the next 35 days, go up to 665, you will make $7,720. But chances are a 74% probability that you're going to lose money and you're going to stay in here somewhere. That's why we don't buy options. That's why we sell options. Popular strategies with options, these are popular. A lot of people buy calls and they buy puts and they buy all that, but it's garbage. It's just garbage. It is a losing man's proposition. So I encourage you to do what we do. We sell options. There's a 5-step process of what we do. We sell options. And therefore, we collect premiums, just like the insurance company. Whoever is buying my options are paying me a premium, so I collect premium. Then we do it at a high probability of success, high percentage of success. And the trades that I put on, you've seen them time and time again, 90% plus. Third is we allow theta. In other words, we allow the options to decay. So what we have sold eventually becomes worthless. Now, what if the market goes against our puts that we sell? We manage chaos. We talk about that a lot, and we're going to be talking about that in the Muscadine Mafia session that will be following. And then the fun part is we rinse and repeat. That's it. The most popular of all option strategies. I hope you guys have a great weekend. I will see y'all Monday.